To start, please take note of our disclaimer. The agenda for this webinar will be as follows: recommendation, nature of business, financial review, divisions, company guidance, and lastly, portfolio guidance. To move on to the recommendation, we recommend an exposure of up to 5.14%. WBHO is a quality construction company with an established track record, strong cash generation, and consistently high ROEs. Shareholders are, however, reminded of the cyclical nature of the construction industry, as well as the contract risk involved in building and construction companies, which increases forecasting risk. WBHO has done well to diversify many of its income streams geographically from both the country and specific state or province point of view. With the majority of work coming from Australia, future results should be much more susceptible to changes in the rand and Australian dollar exchange rate. Earnings growth in the medium term should be above average, as margins adjust to historical averages. The order book remains healthy for the year ahead. We feel that the share offers value, trading on a forward PE of 9 times and 1.7 times its net asset value. The share is underpinned by a decent dividend yield of 3.3%. To move on to the nature of business, the company is listed on the Securities Exchange, operated by the JSE Limited, and is the holding company of a number of subsidiary companies principally engaged in civil engineering and building contracting activities in the Republic of South Africa and internationally. To move on to the financial review, revenue increased by 4% to 31.9 billion rand, supported by 8% stronger revenue growth in the building segment. Geographically, Australia contributed 58% to revenue, South Africa contributed 36% to revenue, and the rest of Africa, the remaining 6%. Adjusted EBITDA rose by 6% to 1.1 billion rand, which combined with an 18% drop in the depreciation and amortization expenses resulted in a 14% increase in adjusted operating profit to 909 million rand and a slightly higher operating margin of 2.8% from 2.6%. Geographically, South African operations contributed 46% to operating profit, Australia 30%, and the rest of Africa 24%. This reflects the healthy recovery in South Africa's profitability, which rose 37% following improved performance from the Roads and Earthworks division and strong growth from the group's local building divisions. EBIT declined by 17% to 826 million rand because of the 170 million rand settlement agreement with the government of South Africa. Profit before tax came in 11% weaker at 1.1 billion rand due to net interest income being up 19% to 241 million rand. Headline earnings were 7% lower at 751 million rand, benefiting from an 18% lower tax expense of 315 million rand. The effective tax rate was 30%. Diluted HEPS from continuing operations decreased by 3% to 1,309 cents, supported by a 2% decline in the weighted average number of shares. Adjusted HEPS, which excludes the settlement, was up 14% to 1,537 cents. Cash generation was once again strong for the year. A gross final dividend of 325 cents per share was declared, an increase of 3.8%. Combined with an interim dividend of 150 cents per share, resulted in the full year dividend of 475 cents per share. WBHO secured an order book of 44.9 billion rand, with Australian operations accounting for 70% of the order book, South Africa 26%, and the rest of Africa the remaining 4%. To move on to divisions, Building and Civil Engineering contributed 25% to revenue and 39% to operating profit. Record levels of revenue, which increased by 8% to 8.1 billion rand, were achieved. This was aided by strong performance in the local building divisions, which was slightly offset by weaker performance in the rest of Africa operations, while the civil engineering divisions remained flat, owing to industry conditions remaining constrained. Operating profit increased by 4% to 385 million rand, resulting in a slightly lower operating margin of 4.7%. The operating margin was negatively impacted by a change in the revenue mix, with a lower contribution from higher margin design and construct work. The building and civil engineering segment secured an order book of 7.2 billion rand, a decrease of 17.2%. In the building division, building activity in Gauteng was underpinned by major retail, commercial office, and entertainment sector developments. Commercial office sectors remained highly active and concentrated in Gauteng, especially Sandton, Rosebank, Tshwane, and Midrand. Projects currently underway includes new offices for Discovery and PricewaterhouseCoopers, as well as new office developments at the Rosebank Towers and Loftus Park. Activity from retail developments remained stable after lower activity in Gauteng was reported due to the completion of Menlyn Main Central Square project in Tshwane and the Tavani Mall in Limpopo. Retail activity was supported by coastal regions, where the construction of Belito and Cornubia shopping centres in KZN is ongoing, and the completion of a new Virgin Active and refurbishment at the Green Acres Centre in the Eastern Cape. In Ghana, the replacement of projects proved challenging, resulting in building activity levels decreasing. The construction of the Kumasi City Mall was completed in the second half of 2017. The design and construct contract for the Standard Chartered Bank is progressing well. In the civil engineering division, revenue remained flat for the year. However, second half revenue improved owing to the construction of the commercial crude oil terminal facility at Saldanha gaining traction. Construction of the stacker and reclaimer for Exxaro at the Grootegeluk mine in Limpopo, as well as the construction of the furnace for Northern Platinum, have progressed well and will be completed in the full year 2018. The re-access works for Kusile Power Station will continue to 2019. Smaller scale projects are being secured in Zambia within the mining, industrial, and agricultural sectors. To move on to the road and earthworks segment, this contributed 14% to revenue and 35% to operating profit. Revenue increased by 6% to 4.6 billion rand, while operating profit increased by 21% to 342 million rand, resulting in a higher operating margin of 7.4%. A better second half performance was reported. The road and earthworks order book secured was higher at 6.2 billion rand, an increase of 106.7%. Local operations mainly comprised of countrywide roadwork and a resurgence in local private sector projects. In Gauteng, the improvements to the M1 near Oxford Road in Johannesburg are ongoing, while the iconic cable stay bridge over the M1 near Sandton and the Catherine Street Bus Rapid Transport project were completed. In KZN, the Bus Rapid Transport project will be completed early next year. In the northwest, the R24 near Rustenburg is nearing completion. In Mpumalanga, the upgrade to the N4 near Waterval, Boven was successfully handed over. In the Free State, construction of two new projects started, namely the N6 near Smithfield and the N1 near Winburg. In the Eastern Cape, the upgrade of the N2 between Grahamstown and the Fish River Pass were completed, and the division has been awarded a further two sections along the N2 near Breidbach and Coombs. Roadspun benefited from sustained activity in the surfacing division. Performance of Edwin Construction was impacted by minimal activity from the provincial road sector. The construction of the N5 near Harrismith helped the performance throughout the year. Two new road projects, namely the rehabilitation of the D670 near Bronkhorstspruit for the Gauteng Department of Transport and the rehabilitation of the R34 near Vryburg for Soundrail, were secured in the second half and are progressing well. Furthermore, a sewer and water reticulation project in Mangwang was secured. Local private sector projects were secured in the mining, energy, and logistics sectors. These included additional work in Northern Platinum's Boyersdal mine and for Sasol, an ash dam, Hall Road, and accompanying earthworks and infrastructure. Private projects also included new lining and drainage on an ash dam for Eskom and roads, bulk earthworks, and other infrastructure for Clearwood Logistics in KZN. The pipeline sector derived a large proportion of work from the LPG import terminal and the crude oil terminal at Saldanha. In addition, projects for a fire protection system at Transnet's Tolton depot and the installation of a steel pipeline at the Neckartal Dam in Namibia supported activity. New projects in the rural housing market were secured in KZN and the Eastern Cape. In Botswana, the division managed to secure projects in the mining sector and a new pump station along the north-south carrier pipeline. In Mozambique, the division struggled owing to projects for various coal mines that were completed early in the year not being replaced. However, the road sector division secured a further section of the EN4. West Africa showed some improvements, with several projects being secured in Ghana, Guinea, and Burkina Faso. Moving on to Australia, this contributed 58% to revenue and 26% to operating profit. Revenue grew by 3% or 5.5% in dollar terms to 18.6 billion rand on the back of strong Asian investment and continued population growth. Severe weather in Queensland and New South Wales, as well as a slow commencement of projects due to longer than expected client planning requirements and financier approvals, impacted activity levels. Operating profit, excluding equity accounted development profit, decreased to 259 million rand. The operating margin eased marginally to 1.4%. The Australian order book secured improved to 31.5 billion rand, an increase of 5%. The building market remained strong. Melbourne and Sydney contributed 68% to revenue. During the year, multi-level residential projects underpinned activity. In addition, high activity in the hotel sector was due to the uptick in Chinese tourism, while the commercial sector contributed 11% to revenue, owing to a growing presence. In Melbourne, prominent residential projects include the Poro, Victoria One, and Empire apartment buildings, as well as the Marina and Aurora Towers. Projects in Sydney include Phase 2 of the Promenade and the Discovery Point apartments. In Brisbane, residential activity has been slowing down for the year. Project selection has therefore been a focus by choosing to partner with developers where the business has strong relationships built on the strength of its Victorian operations. The Queensland business struggled due to the loss-making Korpuru project, where losses were largely due to delays in securing subcontractor packages as the market accelerated, which resulted in unexpected price increases. The Chadstone and Werribee retail projects and the Toowoomba retail project were completed in the year. A key 400 million Australian dollar anchor project at the Elizabeth Quay in Perth, as well as several other mid-sized projects, were secured for the Western Australian building operations. Mid-sized commercial projects in suburban areas, along with medium-density luxury apartment projects in the Monaco Hickey business, were completed. The business continues with its penetration into the sub 50 million Australian dollar building project space. Revenue from the Australian infrastructure business increased 63% to 195 million Australian dollars, driven by the presence in the renewables sector. Opportunities to grow revenue in this sector due to government-driven activity, particularly in the rail, road, and bridge infrastructure space, were highlighted. The Eastern region secured 2 new contracts, while the Western region was a strong contributor for the year. Property. Revenue fell 88% to 2.3 million rand, while our operating loss was 1.5 million rand. This is in contrast to 2016, which has an operating profit of 14.7 million rand. Construction materials contributed 2% to revenue. Revenue declined by 11% to 579 million rand, owing to the challenging trading conditions in the steel business. Operating profit declined significantly to 2 million rand, characterized by rising input costs. A problematic loss-making contract in VSL Construction, which is a subsidiary of Capital Africa Steel, has resulted in disputes over the settlement of claims being referred to the international arbitration by VSL and its joint venture partner. Operating margin was lower at 0.4% from 5.6% in 2016. To move on to company guidance. The group's order book secured at 30 June 2017 increased by 5.1% to 44.9 billion rand, reflecting the strong order book secured by road and earthworks, which is up 103%. Approximately 84% of the 2017 revenues have been secured for the 2018 financial year. The Australian order book remains largely flat, while the building and civil engineering order book has decreased 17%. Softening of the retail and commercial office sectors has resulted in a lower order intake for local building work. However, the retail and commercial residential sectors offer opportunities which is expected to support future activity. The civil engineering division's order book has been supported by the award of the commercial crude oil facility at Saldanha, as well as the award of a rapid loadout facility at Exxaro's Grootegeluk mine. Overall, activity in the civil engineering division has yet to recover to meaningful levels. In Australia, the order book remains strong at 3 billion Australian dollars, and key projects have been secured in Western Australia, New South Wales, and Queensland states. There is good diversification of the Australian order book, where 39% is from residential-only projects, 24% from mixed-use residential and hotels, 9% for retail, and 17% for commercial projects. Retail markets have been impacted by the growth in online shopping. However, by providing assistance in early design development to key shopping center owners, ProBuild is able to target specific construction projects in the near term. The infrastructure order book continues to be supported by ongoing maintenance contracts in the mining and industrial sectors, as well as increasing presence in the renewable energy sector. Projects secured after year-end amounted to 11.7 billion rand, made up of 1.4 billion rand in building and civil engineering, 1.7 billion rand in roads and earthworks, and 8.7 billion rand in Australia. In addition, WBHO is the preferred bidder for a 480 million rand hotel in KZN and a 450 million rand healthcare project in Johannesburg. Mining infrastructure projects secured in West Africa, specifically in Guinea, Burkina Faso, and Ghana, will continue through next year and will have the potential for additional phases. The project pipeline for South Africa totals 55.3 billion rand, split between building of 20.9 billion rand, civil engineering of 12.5 billion rand, and roads and earthworks of 21.9 billion rand. The project pipeline for the rest of Africa totals 20.2 billion rand and is divided into building and civil engineering of 3.2 billion rand and roads and earthworks of 17 billion rand. The project pipeline for Australia totals 55.9 billion rand and is split into building of 43.5 billion rand and civil engineering of 12.4 billion rand. On 23 June 2017, a 40% interest was made in the Byrne Group for a consideration of £12 million. The group specializes in concrete sub and superstructure packages through Byrne Bros, while high-quality new build refurbishment and fit-out projects are offered through Elmer Construction. By purchasing a stake in the Byrne Group, this will enable the company to enter the UK market through lower-risk subcontractor work. On 30 June 2017, a 90% interest of the total of the voting equity in Gridrod Rail Construction Company was acquired for 62.3 million rand through the purchase of shares. The group has been rebranded as ikusasa Rail, where the principal activities will include the construction and maintenance of railway lines, overhead track equipment, track-related civil works, and the supply of related concrete products. The acquisition of ikusasa Rail, in partnership with Faku Family Enterprises, presents the group with opportunities both locally and in the rest of Africa. The primary reason for the acquisition is to optimize the synergies in rail-related construction by allowing the group to provide a full scope of services related to rail construction. To move on to portfolio guidance, WBHO has a capped Swix all-share weighting of 0.14%. We have an overweight guidance, and we have a recommended exposure of up to 5.14%. In closing, if you'd like to place a trade, please contact our trading desk. In addition, should you have any questions, please use the comment section now. Well, that brings us to the end of this webinar. Thank you very much for attending.